You've felt it before. That specific moment when your position goes against you, not by much, just enough to make your hands clammy, just enough to make you refresh your account balance one more time. You tell yourself you're disciplined. You tell yourself you've done the homework. But deep inside, underneath all the charts and indicators and supposed logic, there's a voice whispering that maybe, just maybe, you should cut it now before it gets worse. And here's what nobody tells you about that moment. The professional trader sitting 3 screens away from you in some concrete office building or anonymous coffee shop, they feel it too. They feel the exact same biochemical response, the same cortisol spike, the same ancient lizard brain panic that kept your ancestors from getting eaten by predators. The difference, and this is the difference that separates decade-long careers from blown accounts, isn't that they don't feel fear. It's that they've built a framework so robust, so systematically boring, that the fear has nowhere to attach itself. They've removed the emotional anchor points. And that removal, that systematic neutralization of the heroic narrative, is what we're about to dissect. Let me tell you about 2 traders. The first one, let's call him Marcus, started with $15,000, a laptop, and a dream shaped by every Instagram screenshot of green pea and L statements he'd ever seen. Marcus believed, truly believed, that trading was about those moments, those crystalline instances where you see what others don't, where you go all in on conviction, where you prove to the market and to yourself that you belong among the elite. He studied patterns obsessively. He watched every YouTube breakdown. He joined 3 Discord servers. And for the first 2 months, he was right more than he was wrong. Not because of skill, though he didn't know that yet, but because he entered during a momentum phase where his directional bias happened to align with institutional flow. He turned 15 into 28. He felt untouchable. He started talking about quitting his job. Then came the drawdown. Not a crash, not some black swan event, just a normal, statistically inevitable reversion. Marcus didn't have a framework for normal. He doubled his size to make back what he lost, then tripled it. Within 6 weeks, he was back to 11,000, then 7, then he stopped checking. The second trader, let's call her Simone, started the same month as Marcus, same capital, same market conditions. But Simone's grandfather had been a commercial real estate investor who survived 3 recessions, and he'd told her something when she was young that she never forgot. Survival is a strategy, and the longer you survive, the more strategies become available to you. Simone didn't trade for the first month. She paper traded. She journaled every entry and exit she would have made and forced herself to write down not just what happened, but what she felt in her chest when she clicked the button. When she finally went live, she risked 0.5% per trade. Her friends thought she was insane. 0.5% on a $15,000 account meant she was risking $75 per trade while Marcus was swinging thousands. But Simone wasn't trying to win trading. She was trying to become a trader. And that distinction, that seemingly trivial semantic difference, was the canyon between them. Here's the hidden cost that nobody explains when you're watching highlight reels and reading about George Soros breaking the Bank of England. Heroic thinking makes you fragile. It sounds backwards because we've been conditioned by every movie, every sports narrative, every underdog story to believe that greatness comes from the big swing. The Alornothing bet the refusal to accept limitations. But heroic thinking requires you to be right in ways the market doesn't care about. It requires validation on your timeline. It requires the universe to cooperate with your emotional needs. And markets, as you've probably noticed, are phenomenally indifferent to your emotional needs. When you build your identity around hero trades, around being the person who called the top or caught the bottom or made 6 figures in a week, you create a psychological trap. You need those outcomes to feel competent. You need those wins to maintain your self-image. And the moment your self-image becomes dependent on outcomes you can't control, you've handed your nervous system over to randomness. You become antifragile in reverse. Instead of getting stronger from volatility, you shatter. Every loss isn't just a loss, it's evidence that maybe you're not who you thought you were. Every drawdown isn't a statistical inevitability, it's a personal failure. And so you start making decisions not based on edge or probability, but based on ego repair. You chase. You revenge trade. You break your rules, not because you don't know better, but because following the rules feels like admitting you're ordinary. And the market, patient and mechanical, takes everything. Think about the gym for a moment, because the parallel is almost too perfect. Imagine two people starting a fitness journey on the same day. One person, inspired by transformation videos and 30-day challenges, goes absolutely savage for 3 weeks. 2-hour workouts. Extreme calorie restriction. They're sore, exhausted, but they're convinced this is what it takes, that greatness demands suffering, that the intensity of their effort will compress time itself. The other person follows a program. 3 days a week, progressive, overload, adequate recovery, boring consistency. After 3 weeks, person 1 has lost more weight, feels more validated, posts more updates. After 3 months, person 1 has burned out, binged, quit, restarted, quit again, and is now roughly where they began, but with added shame and metabolic adaptation working against them. Person 2 is still going 3 days a week. They've added 20 pounds to their squat. They've built a habit so mundane it doesn't require motivation anymore. After a year, person 2 has completely transformed their body composition while person 1 is still searching for the next revolutionary program that will finally make it stick. Trading is the same. The person who tries to make 10% a week will either get lucky and then eventually catastrophic or get unlucky and quit. The person who systematically grinds out 0.5 to 2% a month with controlled risk will, over years, build wealth that looks boring on a weekly chart but extraordinary on a decade timeline. Consistency doesn't photograph well. It doesn't make for viral content. But it's the only thing that actually works when you're operating inside systems with embedded randomness. Or consider relationships, since we're mapping the human condition here. You know those relationships that burn white hot, where every conversation is intense, where the highs are euphoric and the lows are devastating, where it feels like the entire meaning of existence hinges on whether they text back. Those relationships make incredible movies. They also make terrible marriages, because intensity is not the same as sustainability. Because emotional volatility eventually exhausts both parties. Because you can't build a life on adrenaline. The relationships that last 20, 30, 40 years aren't the ones with the most dramatic meet-cutes or the most passionate arguments. They're the ones where two people build systems, how we handle conflict, how we distribute labor, how we make decisions, how we repair after hurt. They're boring to describe at dinner parties, but they're where actual human flourishing happens. Trading, again, mirrors this. The traders who last, who are still in the market after 10 years, who've compounded their way to genuine financial independence, they don't have dramatic stories. They have spreadsheets. They have checklists. They have rules they follow especially when it feels stupid to follow them. They've divorced their ego from their execution. And that divorce, painful as it is to accept, is the initiation into professionalism. Let's bring in some structure from behavioral economics, because this isn't just poetic observation, this is measurable cognitive bias. Loss aversion, first articulated clearly by Kahneman and Tversky, tells us that the psychological pain of losing is roughly twice as intense as the pleasure of an equivalent gain. Which means when you're in a losing position, your brain is screaming at you with twice the volume it whispers when you're winning. This asymmetry breaks traders. You cut winners early because the fear of watching them reverse hurts more than the joy of holding. You hold losers too long because realizing the loss makes it real, makes it permanent, makes it your fault. Professional traders know this about themselves. They don't fight it with willpower, which is a depletable resource. They fight it with rules. They decide before the trade where they exit if wrong. They make that decision when cortisol is low, when the position is theoretical, when they can think probabilistically instead of emotionally. Then, and this is critical, they follow the rule even when every fiber of their being wants to give it one more candle. They've accepted that they are not rational. They've accepted that their brain is running software designed for survival on the African savanna, not for navigating leverage derivative markets. And instead of pretending they're above biology, they build systems that account for it. Survivorship bias is another killer that hides in plain sight. You see the traders who made it who are selling courses or managing funds or posting their wins. You don't see the thousands who blew up quietly, who never posted their final loss, who just stopped logging in. And so you assume the survivors did something you need to replicate, some indicator combination, some scanner setting, some secret. But often, not always, but often, the survivors are just the ones who happen to align with a specific market regime during their learning phase and managed through luck or intuition to not blow up before they developed enough skill to sustain themselves. The skill is real, but the path they took might not be replicable, might have involved randomness they don't even recognize. And when you try to copy their aggressive sizing or their conviction-based entries without the context of their entire journey, you're copying the highlight reel and wondering why your movie looks different. The antidote is probabilistic thinking. It's accepting that no single trade matters. That edge expresses over hundreds of trades, not dozens. That variance can and will make you look stupid for weeks at a time, even when you're doing everything correctly. The professional has internalized this. They're not trying to be right on this trade. They're trying to execute their process on this trade. And they trust not with blind faith, but with statistical backing that the process will manifest edge over time. Antifragility, Nassim Taleb's concept, is particularly relevant here. Systems that are anti-fragile don't just resist shocks, they improve because of them. But you can't build an anti-fragile trading approach if you're operating at the edge of your emotional and financial capacity. If a 3% drawdown makes you question everything, you're fragile. If a 5% drawdown makes you break rules, you're fragile. The professional builds in so much redundancy, so much margin for error, that drawdowns become information instead of catastrophes. They size so that even a string of losses, which will happen, which is mathematically guaranteed to happen, doesn't touch their psychological equilibrium. This seems overly cautious to the beginner. It seems like you're not maximizing opportunity. But maximizing opportunity per trade is a beginner framework. Maximizing longevity is the professional framework. And longevity, boring old survivability, is what allows edge to compound. You can have the best edge in the world, but if you size it wrong, if you allow one bad week to tilt you into revenge mode, the edge never gets to express. You're out of the game before the law of large numbers can work in your favor. Now, let's get specific about trading itself, because philosophy without application is just intellectual entertainment. Edge expression is statistical. If you have a setup that wins 55% of the time with a 1.3 risk-reward ratio, you have edge. But that edge will not express uniformly. You will have runs of 7 losses in 10 trades. You will have periods where it feels broken. The professional knows this because they've backtested, because they've forward-tested, because they've journaled enough repetitions to know what normal variance looks like within their system. The amateur doesn't have this data. They trade off feel, off momentum, off whatever worked last week. And so, when variance turns against them, they don't know if it's the system or just noise. They panic. They tinker. They abandon the approach right before it's about to revert to mean. This is why journaling isn't optional. It's not some soft skill for people with too much time. It's the data set that allows you to distinguish between variance and broken edge. Without it, you're flying blind, making decisions based on recency bias and emotional salience instead of statistical reality. Pattern recognition is another area where the professional diverges sharply from the amateur. The amateur sees a pattern, a setup, a formation, and they think opportunity. The professional sees the same pattern and thinks context. What's the overall market regime? What's the volume profile? Where are we in the session? What's my current P and L doing to my risk perception? Am I taking this because it fits my criteria or because I'm bored? Because I need to make back yesterday's loss? Because I want to prove I'm active? The professional has trained themselves to ask filtering questions before entry. Not because they're overthinking, but because they've learned, usually through painful, expensive lessons, that the setup is only half the equation. Timing, context, and internal state make up the other half. And if those aren't aligned, the highest probability setup in the world can still lose, and worse, can tilt you into a cascade of bad decisions. So they wait. They pass on good setups that appear at bad times. They prioritize capital preservation and mental clarity over never missing out. And this restraint, this willingness to do nothing, is almost always what separates the professional from the person who's still searching for the magic indicator. Risk sizing is where most traders intellectually understand the concept, but emotionally reject the application. Everyone knows you shouldn't risk more than 1 or 2% per trade. Everyone nods along when they hear it. Then they open their platform and risk 5% because this one looks really good. Because they need to make up for last week. Because 1% feels like it won't move the needle. Here's the truth. 1% per trade feels insignificant right up until you've compounded 6 months of 20% win rate edge into a 30% account growth. Then it feels like magic. But you never get there because you blow up in month 2. The professional accepts that their position size will feel too small. They accept that their wins will look modest in real time. They're not trying to impress anyone. They're trying to still be trading in 5 years. And they know, not theoretically, but from lived experience, that the trader who survives the longest with consistent edge will out-earn the hero every single time. It's not sexy. It doesn't feel good in the moment. But the professional has shifted their dopamine source from the size of individual wins to the consistency of process execution. They get their hit from following the plan, not from the P&L. And that rewiring, that internal shift in what generates satisfaction, is the psychological foundation of long-term success. Let's talk about the small win versus the big win, because this is where the mythology really damages people. You've been conditioned to celebrate the big win. The 10-bagger, the account double, the retirement trade. And look, big wins are great. They happen. But they're not predictable. They're not something you can systematically produce. They're the tail end of a distribution, and tails, by definition, are rare. The professional builds their entire approach around base hits, around the trades that make 1, 2, 3 times risk, around the setups that occur frequently enough to generate data, that are clear enough to execute without agonizing, that are boring enough that ego doesn't get involved. They stack these trades. 10 base hits at Tutin risk-reward with 60% accuracy, and you've doubled your risk capital without ever needing a hero moment. But that requires patience. It requires you to take the Tutun and not hold for the 5-tun that might never come. It requires you to be okay with winning and moving on instead of maximizing every ounce of potential from every move. The amateur can't do this. The amateur sees the move continue after they exit and feels like they failed. The professional sees the move continue and feels nothing because they executed their plan, banked their risk multiple, and moved on to the next setup. They've defined success as process adherence, not outcome maximization. And that definition is what allows them to stay calm when the amateur is panicking about what they missed. Hero trades versus consistent trades is the core philosophical divide. A hero trade is the one you'll tell people about, the one where you shorted the exact top or bought the exact bottom, the one where you held through terrifying drawdown and got paid, the one that makes you feel chosen. And every trader, professional or not, wants that feeling. But the professional knows that optimizing for hero trades optimizes for variance. It means you're swinging for the fences, which means you're striking out more, which means your equity curve looks like a heart monitor instead of a staircase. Consistent trades are the ones that fit your criteria, that you size appropriately, that you manage according to plan, that you exit without drama. They're forgettable individually, but in aggregate they build wealth. The professional has made peace with being forgettable. They've killed the part of their ego that needs validation from the market. And in killing that need, they've removed the primary psychological driver of bad decision-making. They don't need this trade to prove anything. They don't need this week to be special. They need this quarter to be net positive, and they know the only way to get there is through repetition of process, not through fireworks. Drawdowns are inevitable, and your relationship with them defines your career trajectory. The amateur views a drawdown as evidence that something is broken, that they've lost their touch, that the market has changed. The professional views a drawdown as variance within expected parameters, assuming they've actually tracked what those parameters are. If your system historically draws down 8 to 12% before recovering, and you're currently down 9%, you're not in crisis. You're in the middle of normal. But if you don't know your system's drawdown profile because you've never tracked it, 9% feels catastrophic. It feels personal. And you react emotionally, which compounds the drawdown. The professional has rules for drawdowns. At what point they reduce size, at what point they stop trading and review, at what point they consider the edge broken. These aren't emotional decisions made in the heat of loss. They're predetermined circuit breakers installed when thinking was clear. And they follow them not because they're rigid, but because they know their own psychology well enough to know they can't trust their judgment when they're bleeding. This is humility in action. This is recognizing that you are not your best self under stress and planning accordingly. Tilt is the silent account killer. Tilt is when you're no longer trading your system, you're trading your feelings. You're trying to repair your ego, to punish the market, to get back to even before the day ends. Every serious trader has tilted. The difference is the professional recognizes it, has stop-loss rules for their mental state, not just their positions, and has the discipline to walk away. They've built in forcing functions. If I lose X% in a day, I'm done. If I break my rules twice in a session, I'm done. Not because they're weak, but because they've learned that every dollar lost while tilting is a dollar that has to be made back later while trading properly, and it's just inefficient. The amateur doesn't have these breakers. They keep trading because stopping feels like giving up. They convince themselves the next trade will fix it. And they spiral. The professional treats their mental state as seriously as their capital. They know that protecting their psychology is protecting their edge, and they're ruthless about it. If that means ending the day down when they could keep trading, they end the day. If that means taking a week off after a bad stretch, they take the week. They're optimizing for career length, not daily P&L. Let me give you a practical framework, because abstract philosophy without concrete application just becomes another form of procrastination. First, define your edge with precision. Not I buy dips, but something testable. I buy when price retraces to the 20-period moving average on the 5-minute chart during the first hour of the session in stocks that gapped up on high volume with above-average relative strength in an uptrending market, and I exit at 2 times my risk or end of the session, whichever comes first. That's specific. That's testable. That's something you can backtest and forward test and journal. Second, track every trade in a journal that captures not just entry and exit, but context and emotion. What was the market environment? What did you feel before you entered? Did you follow your rules? If not, why? This creates the data set that allows you to separate edge from variance. Third, define your risk per trade and never violate it. 1% is reasonable. 2% is aggressive, but manageable. Anything above that is gambling. Your position size should be calculated mathematically from your stop distance, not from how confident you feel. Fourth, create rule-based exits for both wins and losses. You decide before the trade where you're wrong and where you're taking profit. Not where you hope to be wrong or hope to take profit, but where the setup is invalidated and where your risk multiple is achieved. Fifth, build in circuit breakers for tilt and drawdown. If you lose more than 3% in a day, you're done. If you break your rules twice, you're done. If you're down 10% from peak, you reduce size by half and review your data. These aren't suggestions. These are non-negotiables. Sixth, review your journal weekly. Look for patterns in your winners and your losers. Are you cutting winners too early? Holding losers too long? Taking trades outside your criteria when you're down? The journal will tell you, but only if you actually read it. Seventh, separate your self-worth from your P and L. You are not your equity curve. You are a person executing a process in a probabilistic environment. Some days, the variance goes your way. Some days it doesn't. Your job is to execute the process with integrity regardless of short-term outcomes. The identity shift from gambler to professional is not about learning more strategies or finding better indicators. It's about fundamentally changing what you're optimizing for. The gambler optimizes for excitement, for validation, for the feeling of being right. The professional optimizes for longevity, for process integrity, for statistical edge expression over time. The gambler needs the market to cooperate with their timeline. The professional accepts the market's timeline and plans around it. The gambler wants to feel smart. The professional wants to be consistently net profitable, which often requires looking dumb in the short term. The gambler sees other traders as competition, as people to outperform. The professional sees the market as the only counterparty that matters and other traders as irrelevant to their process. This shift doesn't happen because you read the right book or watch the right video. It happens because you lose enough money making emotional decisions that you finally accept that your instincts are not your edge, that your feelings are not actionable data, that the voice in your head saying this time is different is the voice that has cost you more money than every losing trade combined. And once you accept that, once you genuinely internalize that you cannot trust yourself under pressure, you start building systems that protect you from yourself. You start trading like a professional. The philosophical climax here is understanding that mastery in trading, like mastery in anything, is not about peak performance. It's about minimum variance in execution quality. It's not about having the best day ever. It's about never having a catastrophic day. It's not about catching every move. It's about catching enough moves while avoiding the blow-ups that reset your progress. The amateur is always searching for the next level, the advanced technique, the secret edge. The professional is endlessly refining the basics, making their execution more consistent, their psychology more stable, their risk management more robust. They know that complexity is seductive, but simplicity is profitable. They know that the trader with 3 setups they execute flawlessly will outearn the trader with 30 setups they execute inconsistently. They've stopped trying to impress anyone, including themselves. They've accepted that trading is not a stage for heroism. It's a craft that rewards patience, discipline, and emotional regulation. And those qualities, those deeply unglamorous qualities, are built through repetition and pain and honest self assessment, not through inspiration or revelation. So, when you feel that panic when your position is against you and your hands are clammy and you're wondering whether to cut or hold or add, remember this: the professional 3 screens away is not calmer than you because they're smarter or more talented. They're calmer because they made a decision about this exact scenario 3 days ago when their nervous system was quiet. They're calmer because they've sized the position so that even if it goes to their stop, it's just another data point, not a catastrophe. They're calmer because they've been here 1,000 times and they know that panic is just noise, just biology, just the part of their brain that doesn't understand statistics trying to hijack their behavior. And they've built a system, boring and mechanical and utterly unsexy, that allows them to acknowledge the fear and then execute the plan anyway. That's the game. That's the entire game. Not being unafraid. Not being superhuman. Just having a plan that's strong enough to override the fear and the discipline to follow it, especially when every part of you wants to do something else. That's how professionals stay calm when retail traders panic. Not because they're different, because they've built different systems. And you can too. But only if you're willing to kill the hero, embrace the boring, and commit to the process even when it feels like it's not enough. Because over time, over years, it's more than enough. It's everything.